recent major moves we've seen in the dollar, we need to know what's next. So I'd like to introduce you to Douglas Borthwick. He is the head of FX and managing director at Chapdelaine right down the street.
Thank you very much.
Oh, Doug, nice to have you on the show, and perfect timing, I might add. You weren't even surprised at the recent moves we've seen in the dollar, but what do you make of it making multi-year lows and U.S. yields multi-year highs?
Well, we wrote about this about a year ago. We said there's going to be a change in the policy for this administration. They've always talked about having a more competitive environment for the U.S. worker. That being the case, the only way to do it is really to weaken the dollar. Now let's go back to 2008. In 2008, the euro was at 160. Today it's sitting there at 125. Folks are saying, wow, the dollar's weakened a lot at 125 and the euro from 105. But really all we're doing is we're taking back the strength that the dollar gained in the back of what happened with the Lehman crisis. So during the Lehman crisis, then backed by Greece, you saw the euro have tremendous gains. Even as the US interest rates were dropping, the dollar ended up rallying. And that's because folks just wanted to get into some safety. They wanted AAA paper, and that's what the US offered. Everyone plowed their money into the US out of Europe. Since then, there's been a change. Obviously, US rates are rising, but so are rates around the world. Rates are rising in Canada, they're rising in Mexico, they're rising everywhere. The ECB is now talking about taking off accommodation as well. So given that's the case, given there's global growth, reserve managers especially are looking at the markets and saying, well, you know what, maybe we shouldn't be all in the US as we have been with our reserves. Maybe we should start putting them into different currencies. They're buying euros, they're buying the yen, and they're also buying the Chinese currency, which makes a lot of sense given that the Chinese currency is now part of the SDR, which is the IMF's basket. That being the case, it means that most reserve managers need to buy China. China trades against a basket of currencies, namely the euro and the yen. So as people buy China, and the Bundesbank's already said they're buying China, the Bank of France has also said they're buying China. Given that's the case, let's say they move 10% of their reserves into China, which is around the weighting that they have in the SDR. That's around $1.3 trillion that needs to be taken out of the US and put elsewhere. And so as you take money out of the US, you see US fixed income sell off, you see yields rally in the US, and at the same time, you see strength in the Chinese currency and in the euro and in the yen.
Well, the Trump administration has repeatedly said that they favor a weaker dollar. And by the way, guys, Doug correctly called that Trump would be elected as well. How successful would the administration be at taking advantage of a weaker dollar? Well,
let's be clear. The Trump administration can't say it clearly to the market that they want a weaker dollar. Mm-hmm. They certainly can throw a trial balloon, as Secretary of Treasury did last week in Davos. But they have to be very careful because of the G20 rules regarding currency manipulation. So what they talk about is certainly, in the long term, we believe in a stronger dollar, but they kind of miss out the whole part of it in the short term. And in the short term, the US administration strongly believes that a weaker dollar is in the US interest as comes to manufacturing in the US and exports.
Okay, so isn't it dangerous if it becomes too weak though?
It's not really dangerous. If you remember, we're in an environment right now where interest rates are extremely low, where the Fed's almost begging for inflation so they can have an answer for why they can raise rates. At the same time, you have wage growth growing very, not growing at all. And so one way to do that is to bustle in inflation. One way you get inflation is by having a weaker dollar. And when you have the weaker dollar, the Fed then has the ability to raise rates. Remember, as the dollar weakens by around 5%, that's almost equivalent to the Fed cutting rates by 25 basis points. So every time the dollar weakens by 5%, it allows the Fed to turn around and say, you know what, now we'll start raising rates by 25 basis points.
So it all plays out. It all plays out. Now,
Now,
every time we see something happen with the US dollar, a major move, China is always mentioned. You talked a little bit about it before, but what role does it play in this scenario?
Well, obviously on the reserves basis, it's a very big role. So the Chinese never really had a reserve currency or one that would be used by other banks. But over the past 5 to 10 years, they've gone to each country and said, let's do bilateral trading arrangements. Maybe we'd like you to pay us now in Chinese renminbi as opposed to in dollars. And they've gone around everywhere saying that when you rule trade and you're one of the first or in the top 2 trading partners for any country, you can dictate how you get paid. The Chinese are sort of thinking now, maybe you don't pay us in dollars anymore, pay us in the Chinese currency. So reserve managers are now building their reserves in that currency. Now that means that China has to build out their treasury market. It's very small. It's only around 100 billion right now that's invested by foreigners in that treasury market. That's going to grow significantly. The Chinese also have much higher interest rates for you to invest in. Why invest in Germany at 0% interest rate? We can invest in China and get a much higher interest rate. And so China, I think, is going to be a destination of choice for many reserve managers, and that's very, very important. Now, do the Chinese care about having a stronger currency? That's probably the biggest question. And you'll constantly read about this, China's very concerned about having a strong currency. Not really, because the Chinese exports to the US are de minimis compared to how much they export to Europe and to Japan and elsewhere. And as long as the folks that also export goods are also allowing their currencies to strengthen, then it doesn't affect China that much in the short term or the long term. And so the Chinese are happy to let their currency strengthen as long as the euro keeps on going higher and as long as dollar yen keeps on going lower. And based upon the basket nature of its currency, everything's moving in that direction.
So all in all, are we going to see a pickup in volatility and FX this year? And what are your favorite pairs to follow?
We are going to get more volatility this year as central banks start getting out of markets. So central banks have been very, very involved in markets, whether it's the US Treasury market, the US mortgage market, in Europe, the corporate market, the sovereign markets. As they start to bring themselves out of it, you see volatility start to pick up again. And soon we'll have meetings where we'll be deciding, will the Fed raise rates or will they stay on hold? Will the ECB raise rates or will they stay on hold? We've just gone through, 9 years where we always knew that either cut rates or be on hold forever. And that level of uncertainty, not just in the US, but for every currency, means much more volatility going forward.
And you like to follow individual pairs rather than the Dixie, correct?
I don't think anyone follows the DXY.
Oh!
So yes, we look at individual pairs. Now one thing that is very notable is that this administration, specifically Wilbur Ross, the Secretary of Commerce, has come out and he said, look, there's a number of countries that we think are, maybe their currencies are a little bit too strong, or too weak relative to the dollar. Mm-hmm. Note how they say that. Now, and these also have significant trade surpluses against the US, and the US has a trade deficit. Countries like that would be Mexico, Japan, China, and Europe. And so I think you're going to see appreciation of these currencies versus the US dollar over the next year. That means the euro goes from 125 through 130 up to maybe 140, 150. Dollar yen breaking back below 100, and dollar against the Chinese currency dropping below 620 and 615.
Wow. Well, with all your predictions being spot on them, I wish you could tell us who's going to win the Super Bowl this weekend, because a lot of money is on that.
I can't tell you about that one.
All right. Like I said, whatever you'd say, I'd follow. But anyway, Doug, it's so nice to have you on the show.
Thank you.
Perfect timing. Thank you for sharing your predictions and perspective.
Thanks for having me. Thank you.